My name's Kathleen Engel, and I'm a research professor of law at Suffolk University Law School. And my research expertise is in financial services markets, which means everything from borrowers to Wall Street investment firms, all sorts of credit products. The traditional banks would be reluctant because the people didn't have the income to support the mortgages, and they would have to get enough income to pay off the original mortgage, which often was bigger than actually the value of the house. So that's what we call underwater. And when that happened, they had very few options. They could try to negotiate with the lender to sell the house for, the size of the mortgage, but the lenders aren't always willing to do that. But in most cases, they ended up in foreclosure, and they lost their home, a home that maybe had been in their family for generations, the home where they celebrated births and deaths and all the holidays. A tremendous emotional effect, not just economic effect, when they lost their homes. Another thing that we saw were shared appreciation mortgages. What happens is somebody will finance the property, give the funding, make the loan available to somebody who's, say, about to foreclose, and then they reduce the size of the debt that the borrower owes. And what that does is it makes the monthly payment affordable usually. I mean, they wouldn't do it if it couldn't. And then what they do is they say, when you go to sell the house, if it hasn't appreciated or it's lost money, you don't owe anything to the entity that loaned it to you. But if the house has appreciated, they get a cut of the money. So to give you an example, I couldn't afford to buy a house when I moved to Boston 30 years ago, but my husband's employer had shared appreciation mortgages, so they gave us the down payment. And then when we sold the house, we had to give them back a set amount of money based on what they had loaned to us. So shared appreciation mortgages are a really important tool by a legitimate institution, is highly valued, both among people who study housing markets and financial markets, the federal government, state agencies, as long as they're being made by legitimate, respectful, and respected organizations. They're terrific. And during the subprime crisis, and really the foreclosure crisis that followed it, we saw a lot of effort to expand shared appreciation mortgages. I would say they are a critical tool for helping people stay in homes. And that benefits not just the borrowers, but neighborhoods, the society. Stability is good for children going to school, even the social networks that people have. So yes, I wish we could have millions of them. It would have saved everybody a lot of pain and a lot of money. I'm a big fan of BlueHub and have been for decades. BlueHub is nationally known. I go to conferences around housing, affordability and accessibility and foreclosure and housing development, and 9 times out of 10 there's somebody from BlueHub there, and people want to know how they made this work. I would say that BlueHub is an organization that the state lauds as being incredibly effective and helpful for our community. There are a lot of people who are very grateful that they get to stay in their homes and that BlueHub made that possible.
For more information on BlueHub Sun, go to bluehubcapital.org/foreclosure-relief.